Welcome and thank you for joining today's conference, Department of Market Monitoring 2025 Quarter 2 Report on Market Issues and Performance Public Call. Before we begin, please ensure you have opened the chat panel by using the associated icon located at the bottom of your screen. You can submit questions throughout the presentation to all panelists from the drop-down menu in the chat panel. Enter your question in the message box provided and send. All audio lines have been muted until the Q&A portion of the call. If you require technical assistance, please send a chat to the event producer. With that, I'll turn the call over to Ryan Kurlinski. Please go ahead.
All right. Hello, everybody. This is Ryan Kurlinski. I'm a manager in the Department of Market Monitoring. We are the independent market monitor for the ISO's markets, including the Western Energy Imbalance Market. First off, let me apologize. Somehow the incorrect link for this meeting got put on the public CAISO webpage. Appreciate everybody who worked quickly to try to fix that once we realized that there was no one on the call a few minutes before the call started. So with that, I may have to abbreviate Q&A sessions today. We'll see. We'll open up for some questions. I'll stop at a few select points to see if there's questions. You can put those in the chat or raise your hand. So yeah, with that, I'll be going over highlights today from our recently published Q2 2025 report on market issues and performance. The charts and analysis and the report in these slides are the work of a team of economists and data specialists in the department. All right. If you confirm you're seeing the slides here, gas price slides?
Yes.
All right. Thank you very much. All right. So this chart shows monthly average natural gas prices at major gas hubs around the West, as well as at the Henry Hub, which is a national reference point for natural gas prices. At most Western hubs, gas prices were up large percentages from their low second quarter 2024 values, but they were down at Northwest Sumas. Right? That's the major gas hub in the Pacific Northwest that's located near the border of Washington and British Columbia. So gas prices there at Northwest Sumas were down 19% from the second quarter of 2024, but gas prices at PG&E Citygate were up 27%. Prices at Northwest Opal in Wyoming were up 64%. SoCal Citygate gas prices were up 80%. Henry Hub prices were up 55%, and El Paso Permian prices increased from a quarterly average of -5 cents per MMBTU in the second quarter of 2024 up to $1.30 per MMBTU in the second quarter of 2025. All right, this graph shows the load-weighted average monthly 15-minute market price for each WEIM region. 15-minute market prices across the WEIM averaged about $26 per megawatt hour. That's up around 12% overall compared to the second quarter of 2024. This increase was driven by higher natural gas prices and a little bit by load being up 1.4% compared to Q2 2024. The regional gas price trends we just looked at on the last slide, those contributed to differences in how regional electricity prices changed from Q2 2024 to Q2 2025. With Northwest Sumas gas prices down 19%, we see PowerX electricity prices down 18% year over year, and the electricity prices in the rest of the Pacific Northwest were up less than the other regions, right? So Pacific Northwest prices were up only 14%, whereas in contrast, California prices were up 22% compared to the second quarter of 2024. Intermountain West prices were up 27%. And Desert Southwest prices were up 40%. We can also see on this graph that second quarter prices converged across regions compared to prior quarters in the last couple of years. We'll see in a few slides that the transmission congestion that drives a lot of the price separation between regions was down in Q2 2025 compared to Q2 2024. And a driver of that was lower relative costs in the Pacific Northwest that led to less south to north congestion during the middle of the day. The highest average prices over the quarter were in California, PowerX, and the Pacific Northwest. Greenhouse gas costs in California continue to be the major cause of higher prices in California during non-solar hours. And during midday solar hours, south and north congestion contributed to elevating PowerX and Pacific Northwest prices compared to other regions. The black diamonds in this chart show average 15-minute market prices for the whole quarter for each balancing area. The balancing areas are separated by regions, and then within each region, they are sorted from left to right in descending order of their average 15-minute market prices. Each balancing area's average price is decomposed into its components, such as congestion from constraints in the CAISO balancing area, that's the yellow bars, congestion from constraints in other WEIM balancing areas, those are the turquoise bars. The greenhouse gas constraint contribution is the green bars, and congestion from WEIM transfer constraints are the red bars. South to north congestion during midday solar hours was a significant contributor to price separation between balancing areas, as we've seen the last few quarters. Looking at the yellow bars, congestion on constraints in the CAISO balancing area decreased prices in the desert Southwest and Southern California relative to the Pacific Northwest, Northern California, and a couple of balancing areas in the Intermountain West. We also see from the turquoise bars that congestion on constraints in the Public Service Company of New Mexico, that increased prices in that balancing area as well as in El Paso Electric relative to other areas. And the red bars show congestion on WEIM transfer constraints increase in prices in the Pacific Northwest and most of the Intermountain West relative to other areas. The green bars below the horizontal axis, those show greenhouse gas costs for power in California. This is the main contributor to elevating prices in California balancing areas relative to other WEIM balancing areas during the non-solar hours in the evening and early morning. All right, so this chart is also showing load-weighted average WEIM 15-minute market prices for each region. But the colored lines in this graph show each hour's average cost for the second quarter for each region. That's measured on the left axis. The gray bars show WEIM system-wide average net load for each hour. Those values are listed on the right axis. On this one, we see most of the south to north price separation occurring during the midday solar hours. And that's when the CAISO balancing area and also Nevada Power, when they had extra solar, which the market sent to other WEIM regions, including to other balancing areas in California. That caused congestion on major south and north paths, including WEIM transfer constraints into northwestern balancing areas. So during these solar hours, prices in the Pacific Northwest were higher than elsewhere in the WEIM. During non-solar hours, there in the morning and evening, the California prices were higher, mainly due to GHG costs. Prices in the other regions were reasonably well converged during these hours. Aside from the higher prices that we see in the yellow line there in the desert Southwest in hours 19 and 20. Congestion into New Mexico, El Paso, and Salt River Project during these hours were the main cause of those elevated prices you see there, that yellow line, the evening hours. Looking also at the gray bars, we see that the shape of the 15-minute market prices continue to follow the WEIM system net load shape, and especially so in the California, Desert Southwest, and Intermountain West regions. All right, this chart shows the total average impact of congestion, right, from both transfer constraints and internal constraints on price separation between each balancing area. The values are an average of congestion in the 15-minute and 5-minute markets. The red bars show the average impact of congestion on a balancing area in the second quarter of 2025. The blue bars show the impact of congestion from the second quarter of 2024. We see that for every balancing area besides El Paso, New Mexico, Salt River Project, and Idaho, the magnitude of the impact of congestion on the balancing area's prices was greater in the second quarter of 2024 than in the second quarter of 2025. As mentioned, see a few slides back, Regional prices were relatively well converged in the second quarter of 2025, as the average impact of congestion on price separation was down compared to recent prior quarters. All right, the left axis of this graph shows the percent of intervals that transfer constraints into or out of each WM balancing area were binding in the 5-minute market this quarter. The red bars show the frequency of congestion into the area, and the green bars show the frequency of congestion out of the area. The dots, or I guess they're blue diamonds, those show the average impact of transfer congestion overall on the balancing area's 5-minute market prices. As we've seen a lot over the last few years, PowerX was again frequently transfer constrained. In the 5-minute market, PowerX, they're labeled as BCHA here. They were import constrained during around 48% of intervals, and they were export constrained during about 21% of intervals. Over the quarter, PowerX prices were $4 per megawatt hour higher because of WIM transfer congestion in the 5-minute market. The rest of the Pacific Northwest region was also pretty frequently transfer constrained relative to the rest of the WIM system. In the 5-minute market, these balancing areas were import constrained about 16% of intervals and export constrained in about 10% of intervals. And keep going through the difference for some of the price slides here, then I'll stop for a second for questions if anybody has them. The yellow and green lines here show monthly average peak period bilateral power prices at the Mid-Columbia and Palo Verde trading hubs from the Intercontinental Exchange, ICE. The dashed black and gray lines show monthly average ISO market data prices at the Pacific Gas and Electric and the Southern California Edison load nodes. The average ISO market prices, those are for the same hours as the bilateral peak period products, are hours 7 to 22 on all days, but Sundays and holidays. So some of the trends we saw on the ISO market prices also existed in the bilateral prices. So mid-sea prices right up in the Pacific Northwest, those were relatively well converged with bilateral Palo Verde prices in the Desert Southwest. Prices right at the Northern Hub averaged $37 per megawatt hour, which was a little bit higher, $3 per megawatt higher than average prices at the Southern Hub. The ISO market day-ahead prices, those averaged $29 per megawatt hour. That was up about 27% from the second quarter of 2024. And the day-ahead market prices at PG&E in Northern California were on average $11 per megawatt higher than prices at SCE in the South. The solid black line in this chart has the same bilateral mid-sea prices from the last graph, and the light blue line is the same ISO market day-ahead PG&E price. This graph adds the monthly load-weighted average WEIM 50-minute market price for load nodes in balancing areas in the Pacific Northwest. That is the dashed black line. And we're also adding the average 50-minute market PG&E price. That's the dashed light blue line. This chart shows that the mid-sea bilateral prices continue to be higher than WEIM prices in the Pacific Northwest and higher than day-ahead and 15-minute market prices at PG&E. This continues to trend from most recent quarters, with the exception we talked about a few quarters ago. The exception was Q4 2024. The $37 per megawatt hour average bilateral mid-sea price, that was about 33% higher than ISO 15-minute market prices in the Pacific Northwest. Okay, and last slide for us, stop for questions. This chart's the same as the last slide, but it's for the Southwest. All right, solid red line is the monthly average day-ahead bilateral price at Palo Verde. Dashed red line is a comparable WEIM 15-minute market prices. That is the load-weighted average price for load nodes in balancing areas in the Desert Southwest. And then the chart also includes the ISO market day-ahead and 15-minute market prices at the SCE load node, the solid yellow and dashed yellow lines. And similar to the trends we saw in the north, bilateral prices at Palo Verde continue to be higher than ISO 50-minute market prices in Desert Southwest balancing areas, and they were higher than ISO 15-minute and day-ahead market prices at SCE. and that the $34 per megawatt hour average bilateral Palo Verde price was almost 47% higher than ISO 15-minute market prices in the desert Southwest over the second quarter. All right, with that, let's stop for questions. I think I have this up so I can see the chat. If anyone has that, or raise your hand.
We actually do not have any questions in the queue at the moment.
Okay. I got one thing, you can't see the slides, but I'm hoping people will chime in if they can't see the slides. Other people will chime in. Okay.
Yeah, I addressed it directly.
Oh,
they're good now.
Awesome.
They
Thank
can
you.
see them. Of course, my pleasure.
Fantastic. Good. That would be disappointing if no one can see the slides for all that. All right. It's going to be a little tight today with the opening delay. All right. So for the next few slides, we'll look at supply conditions. The figures show changes in supply in the various WEIM regions from the second quarter of 2024 to the second quarter of 2025. Positive values show an increase in the fuel type compared to Q2 2024, while negative values show a decrease in the fuel type. And the black line shows the hourly average increase or decrease in load. But before I discuss any particular region, I want to note that across the whole WEIM, hourly average solar generation increased by about 1,950 megawatts, or 17% compared to Q2 2024, and solar production increased in each region. But average hourly generation from wind is different. That decreased by about 730 megawatts, or 7.5% when aggregated across all the regions of the WEIM. All right, so moving on now to this graph, showing the year-over-year changes for the Intermountain West region. In the Intermountain West, coal generation increased 710 megawatts, or 23% on average, compared to the second quarter of 2024. And coal production was up even though the quantity of coal bid into the WEIM remained similar between the two quarters. We did analysis estimating the cost of power from coal units compared to the cost of power from natural gas units. And with the year-over-year increases in natural gas prices and with coal prices staying pretty constant, power from coal in the Intermountain West was frequently less expensive than power from natural gas resources in the Intermountain West and some surrounding WEIM regions. So in prior quarters, changes in coal production were often driven by changes to outages in large coal units. But the increase in coal production in Q2 2025 compared to Q2 2024 appears to be driven a lot by economics. Note that with the increase in coal production, we see a decrease in net interchange into the Intermountain West, or it could also be interpreted as an increase in power flowing out of the region. That's especially during those non-solar hours. The dark red bars are net hourly block imports into the region. The light red bars are net WEIM transfers into the region. Both are negative on average during the non-solar hours. That indicates less power flowing into the region, or potentially more power flowing out of the region during those morning and evening hours when that increase in coal production was the greatest. So this chart actually switches up a little bit, supports that last chart. This is showing the average of each day's maximum outages during peak hours as broken out by fuel type for the Intermountain West region. So comparing coal unit outages, those are the black bars, in Q2 2025 to Q2 2024, we see there were actually more coal units on outage on average during the second quarter of 2025 compared to a year earlier. So again, unlike recent past quarters where increases in coal production could be explained largely by decreased outages to coal units, coal production was up year over year in the Intermountain West despite the overall bidding quantity from coal being slightly lower. All right, now we're back to looking at the year-over-year change in average hourly generation by fuel type. This chart's for the Desert Southwest region. Net interchange into the region was up significantly during those non-solar hours. It implies that much of the increased coal generation and decreased net interchange into the Intermountain West was decreasing the net interchange out of the Desert Southwest. On a slightly different note, solar production and battery charging was up significantly during midday hours. Battery discharge, you see, was up a lot during evening hours. It's worth noting that net battery discharge increase in every non-solar hour. So I'd say like hour 19 through hour 6 the next morning. This graph is showing that same year-over-year generation changes for the California region. That includes the CAISO balancing area here. Similar to the Desert Southwest region, California had large growth in solar and battery charging during midday hours, and an increase in net battery discharge in all non-solar hours, again from hour 19 through hour 6 the next morning. And that included very significant growth in battery discharge in those evening hours compared to the second quarter of 2024. California also had some growth in net interchange into the region, mainly from WEIM transfers during non-solar hours. All right, finally here looking at the Pacific Northwest. So hydro generation decreased in every region in Q2 2025 compared to Q2 2024, with the exception of the Pacific Northwest. Where you see here, hydro production was up 1,320 megawatts, or 9% on average across all hours. The higher hydro made up for some large nuclear outages you can see on this chart, and it also allowed a decrease in net interchange into the region during those non-solar hours. This graph shows average 5-minute market net flows of WEIM transfers between regions, and that's for every hour of the second quarter of 2025. Again, I think we've been consistent now that export transfers out of a region are shown as negative and import transfers into a region are shown as positive. During midday solar hours, the CAISO balancing area continued to be the main exporter of WEIM transfers, transferring power to the other regions. And during evening and early morning solar hours, WEIM transfers were mainly from the Intermountain West and Desert Southwest to California balancing areas. This graph is showing those same 5-minute market net flows of WEIM transfers between regions each hour, but it shows for each of the last 5 quarters. And again, export transfers are negative, import transfers into a region are positive. The main point to take away from this is there were transfers out of the Intermountain West during non-solar hours had been growing each quarter compared to the previous quarter over the last year, right? So they've been growing compared to the immediately previous quarter, right? But we see for Q2 2025, transfers out of the region were down compared to the prior quarter, right? Q1 2025. So transfers out of the region for these hours were still up compared to the same quarter of the prior year, but the trend we had seen of growing transfers out of the Intermountain West each quarter compared, to the immediately previous quarter didn't continue into Q2 2025. Let's see one more here. I'll stop for questions again. This graph is now showing the average 5-minute market net flows of WEIM transfers between specific balancing areas during hours ending 20 to 22 over the second quarter of 2025. The inner ring is showing the balancing area that the transfer is exporting out of, and then the colored bar flows from there to the importing balancing area. This chart shows that during hours 20 to 22, PAC East and Idaho Power of the Intermountain West were net exporters, and so were most balancing areas in the Desert Southwest. Pacific Northwest was also a significant net exporter of WEIM transfers during these 3 hours on average over the quarter. All right, so there we stop for questions. If you have a question or two.
Just a reminder, to indicate you want to ask a question verbally on WebEx, click the raised hand icon at the bottom center of your screen. You will hear a beep tone when you are unmuted. At that time, state your name and question. I don't have any raised hands or questions in the queue, in the chat.
All right, then. So people want to let me try to get through all the material. I'll do my best here. Lots of questions might help, but definitely please feel free to ask questions. Although I'll say at the end, you can always follow up with questions with us offline. Shoot me an email or shoot DMM an email. we're happy to chat or answer questions over email. This chart shows the distribution of WEIM system load for the second quarter of 2025. That's a solid blue line. And again, all these are all the 5-minute market load forecasts. The dashed red line is the load distribution for the immediately prior quarter. That's Q1 2025. And the dashed blue line is the load distribution for a year ago, the second quarter of 2024. The area under each of these curves sums up to 1. So the area under any particular load segment is the proportion of 5-minute market intervals with load that's within that range. The load distribution is similar for the second quarters of 2025 and 2024. Some of the differences being right at the lower end of the load range, that the solid blue line falls below the dashed blue line, indicating fewer load intervals in Q2 2025 compared to Q2 2024, especially below about 62 gigawatts. And then we see more intervals in Q2 2025 with load at medium levels around 65 to 70 gigawatts. But that's something I thought was interesting, maybe obvious when you think about it, that the load distributions for the second quarters of the last 2 years are significantly different from the first quarter of 2025. I think that Q1 2025 load distribution, pink, more symmetric, right? And the Q2 2024, Q2 2025 load distributions, those skew further to the right. And it's because second quarters have more intervals with high system loads well above the most typical load levels for the quarter. Average WIM system load for the quarter was about 74.7 gigawatts, again, up about 1.4% from Q2 2024, but down slightly from the average load in the first quarter of 2025. Peak WEIM system load for the quarter was 123 gigawatts on June 30th, hour 18, interval 11, just about the last interval of hour 18. And this was higher than the peak WEIM load from Q2 2024 by about 3 gigawatts. Congestion rent and loss surpluses, those are collected in the day-ahead market. Congestion rent accrues from load, paying more for the congestion component of the locational marginal price at load nodes than generators get paid for the congestion component of price at generation nodes. Quarterly congestion rent is shown here in the blue and yellow bars. The yellow bars show the congestion rent specifically from intertie constraints, and the blue bars show congestion rent from internal transmission constraints. In the second quarter of 2025, congestion rent was $128 million. It was down $25 million, or down 16% from the second quarter of 2024. The graph, you can see in the graph here that that's from a decrease in congestion rent from both internal transmission constraints and intertie constraints. The loss surplus, shown in the green bars, that accrues from the difference between what load pays into the market for the loss component of LMP and what generators get paid for the loss component of LMP. And see that loss surplus, the loss surplus was about $8 million, or 38% higher in Q2 2025 compared to Q2 2024. And that increase is due to higher day-ahead market energy prices. This graph shows quarterly CRR auction revenues received by transmission ratepayers. That's the blue bars. And it also shows the payments made to those auction CRRs based on day-ahead market congestion rents. That's the dark green bars. When auction revenues received by ratepayers are less than the payments that are made out to those auction CRRs, then transmission ratepayers lose money from the CRR auction process, and those net losses are shown by the dark gold line. Q2 2025, transmission ratepayers lost about $9.1 million from the CRR auction design. This was about 8% of total day-ahead market congestion rent. Reforms to the CRR design in 2019 included were so-called Track 1B enhancements, and that limited the payouts to CRRs to just the congestion rents actually collected on each constraint in the day-ahead market. The reduction in the payouts to CRRs bought by non-load serving entities due to these reforms are shown by the light green bars. And in Q2 2025, these Track 1B reforms reduced payouts to the non-load serving entities who bought the auction CRRs by about $14 million. So it significantly reduced overall ratepayer losses from the auction design. Okay, I'll explain this again. It can be kind of a complicated one. Assistance energy transfers. That's an optional program that WEAM entities can opt into on a daily basis. If they're opted in and the area fails a resource sufficiency evaluation test, the balancing area gets charged the bid cap for the lower of the amount by which they failed the resource sufficiency test, or the total amount of WEAM transfers scheduled into the area. The bid cap that gets charged is usually the $1,000 per megawatt hour. Opting into assistance energy transfers can allow the area to get extra transfers that they may not have been able to get if they had not opted in. So if not opted in, and when an area fails an RSE test, that area's transfers in are limited to what the area transferred in during the prior interval. But if an area is opted in, when they fail the test, they can get transfers up to the full transmission capacity that they had made available for transfers. And this table is showing the WEAM transfers that each balancing area received that were in excess of the transfers they would have received had they opted in. Sorry, had they not opted into assistance energy transfers, right? So it's showing the excess that they would have gotten if they had not opted in. So 9 WEAM entities opted into assistance energy transfers for at least one day during the quarter. 7 of them failed a resource sufficiency evaluation test during at least one interval when they were opted in, and 5, these 9 entities received WEAM transfers that were in excess of what they would have received if they had not opted in. NV Energy received the most additional megawatt hours of transfers due to opting in. They got 65 additional megawatt hours, but their cost per additional megawatt hour of WEAM transfer was a relatively low $264 per megawatt hour. And that's because they failed the test by less than the amount of extra transfers they received, right? That limited the number of megawatt hours that they got charged the $1,000 per megawatt hour bid cap for. Also noteworthy, balancing area of Northern California Bank opted into receiving assistance energy transfers for the first time since the program was implemented. So as of the end of Q2, 11 of the 23 WEAM balancing areas had opted in on at least one day. All right. So the CAISO balancing area uses adjustments to the residual unit commitment market load forecast. They do that in order to procure extra capacity to cover uncertainty between what the day-ahead net load forecast is when it runs, right, and what the actual net load may ultimately end up being. CAISO looks at system conditions to determine which percentile of uncertainty in the day-ahead net load forecast that may materialize in real time that CAISO thinks it needs the capacity to cover. So CAISO will choose to adjust the load forecast to cover the 97.5th percentile of potential uncertainty, or the 75th or 50th percentile, or to make no adjustment at all. Or to make no adjustment at all, that means that CAISO BA is not procuring any capacity to cover any potential uncertainty that might materialize between day and real time. This graph is showing average RUC adjustments that the CAISO made each day over the peak morning and evening hours between May 7th, 2024, when they made major changes to their method, and between May 7th, 2024 and June 30th, 2025. And the color coding is showing DMM's estimate, our estimate of which percentile of uncertainty the adjustment was intended to cover. So during the second quarter, DMM estimates that CAISO attempted to procure capacity to cover the 97.5th percentile of potential net load uncertainty on only one day. CAISO targeted the 75th percentile on 2 days and the 50th percentile on 45% of days. So during the rest of the quarter, that's 52% of days, no adjustment was applied to procure capacity to cover uncertainty. And why does this matter? I'll explain this again. I've talked about this for the last several reports, but I think it's worth mentioning again. This could end up being important. the percentile of uncertainty that CAISO is aiming to cover with this RUC adjustment has implications for the extended day-ahead market's imbalance reserve product demand curve. That's because the RUC adjustment is meant to procure capacity to cover basically the same net load uncertainty that the imbalance reserve up product is supposed to cover. But the imbalance reserve up product demand curve is designed to pay $25 per megawatt hour to get capacity to cover the 97.5th percentile of uncertainty in all hours of all days. And as you can see, right, from this chart, right, from the CAISO's use of the RUC adjustment over the last few quarters, CAISO rarely needs to procure capacity to cover the 97.5th percentile of uncertainty. On most hours and most days, CAISO's been relying on capacity that does not have an ISM or RUC award. It's been relying on them to show up in real time to meet most net load uncertainty that might materialize. So the low number of hours in which the CAISO uses the 97.5th percentile target in RUC indicates that the imbalance reserve product demand curve may be much too high during most hours. Okay, just 2 substantive slides left. Might make it through this. This chart shows total monthly real-time and balance offset charges for all balancing areas that are participating only in the WEIM real-time markets. Offset's broken out into its 3 components. That's energy in blue, congestion in green, and the losses in yellow. Credits paid out to balancing areas are negative, while charges that have to be collected from balancing areas and allocated as costs out to their load, those are positive. So overall, the total real-time balance offset for these WEIM only entities was a $15 million credit. That's down from a $41 million credit in the second quarter of 2024. $14 million of that Q2 2025, $15 million credit. $14 million of that was from the congestion portion, shown in green here, dark green, in the credit. So the congestion credits, they're mainly from congestion rents collected on WEIM transfer constraints, right? When the total transfers exceed base transfers on a binding transfer constraint. It's definitely worth noting we break this out by balancing area in the report. While this offset was a credit overall, there were large discrepancies between balancing areas. Right? For example, PowerX had a $5.7 million credit for the quarter, and Salt River Project had a $7.1 million credit. But Public Service Company New Mexico had an $8.5 million charge, and Arizona Public Service had a $2.6 million charge. Right? Those are costs that allocate back out to entities in their area. Now the last substantive slide here. This chart shows monthly real-time and balance offset charges for the one balancing area, CAISO balancing area, that's in the day-ahead market. So whereas many balancing areas only participating in those WEIM real-time markets have credits from this charge code, the real-time and balance offset has consistently been a large charge that has to be allocated to CAISO balancing area load and exports. There's different drivers of this real-time balance offset for balancing areas in the day ahead. They're in both day ahead real time versus balancing areas that are just in real time. So that's why we're separated out like this. The total uplift charge in the second quarter of 2025 was $57 million. So similar to the $55 million charge in the second quarter of 2024. And $56 million of this uplift was from the congestion component. That's what you see in green there. That's mainly caused by transmission constraint limits having to be set lower in the real-time markets than they were set in the day-ahead market. Okay, with that, let's stop to see if there's any questions before I wrap it up.
We do have one hand raised from Alan.
Alan, thanks for the question.
Hi, can you hear me?
I can hear you.
Alan, hi, Alan Meck, PG&E. One question, I'm a little curious about comparing slides 16 and 18, I think it was, showing the total KISO transfers into WEIM. So yeah, slide 16 shows a lot of transfers to the Pacific Northwest, some into the Intermountain West and some into the Desert Southwest. And then slide 18, though, seems to show the KISO exports only going to Bank and PowerX and maybe a little bit to LADWP. Is the difference between the two just because this one is measuring just the peak hours?
Yeah, exactly. So if you look at that chart, if you look here, hour 20 to 22, see the boxes as peak hours.
Okay.
So this is that. Yeah. So this chart showing the net kind of regional transfers just between the different regions, and then the circle chart is showing for those 3 hours how all that's actually calculated, looking at all the different transfers between individual balancing areas.
Okay.
Right. So in this one, you see for hours 2022, the KISO balancing area is actually a net importer of WM transfers, which you see kind of those during those peak hours 20 to 22. I don't know. We define peak as in different ways in different charts. So I hope, yeah, it does get confusing. We put this one here. We're still calling peak hours 20 to 22.
It makes sense. Thanks for the explanation.
Yeah, no problem. Thanks for the question. Any other questions?
We have another hand raised from Robert Fisher.
Okay. Jump back. Robert, he will answer your question.
Okay, Ryan, can you hear me?
Yes, I can hear you.
Okay. On your slide about the RUC and the P95, the P75, and the P55, have you ever looked, I'm very curious, you got me thinking about something in regards to how much actual additional capacity is being procured. Because, for example, you're still going to have must offers in real time. That additional RUC capacity is not going to get on peakers, and, you know, it's mostly just for the longer start resources. And so I see, you know, for May and June of 2005, we have an additional 1,500 megawatts, but what was the resultant RUC capacity that was procured for that time frame? That's what I'm kind of curious about.
You're saying the actual RUC capacity procured versus just the adjustments?
Yeah, what capacity was actually procured out of that 1,500 megawatt bias? Because you're still going to have must offers into real time, right? And so the only additional is going to be for maybe some longer start commitments. So have you guys looked into those things, or it just made me start to think about that a bit?
So we have we certainly have the charts in there showing what the procurement was, you know, summarizing what the procurement was. We haven't tried to estimate what the kind of type of resources were that were incrementally procured due to the adjustments or not. That's tricky. That's an interesting question, though.
Okay.
Thanks for that. Yeah, no problem. All right. With that, we are at time. Let me just wrap it up by saying we referenced this slide. Get more information on the Department of Market Monitoring. We really welcome any questions you may have. Shoot an email to me individually, but also include on there that DMM address, dmm@kiso.com. Be happy to set up individual meetings with people to chat or answer questions over email. Thank you very much, everybody. That'll do it for this quarter. Look forward to speaking again about the Q3 report in December of this year. Thank you.
That concludes our conference. You may now disconnect.